I was going through the comment section of a post on She Leads Africa, and these questions, in fact, they asked people to talk about their challenges in their business at the time, and a lot of people had comments to give. If you guys hear voices in the video, my neighbors are outside, I cannot do anything. I really want to get this video done. And so I was going through the comment section and I noticed that there was a lot of question around how do I get my business to be profitable. And I just felt the urge to make this video because I know for a fact that part of why I shut down my businesses some 2 years ago was because I did not understand profit. I didn't understand what it means for your business to be profitable, especially for a business that is just starting out. So I'm just going to take you guys through a lot of information about having and building a profitable business. If you're watching this, I would suggest that you have a pen and a paper because I'm about to take you guys to school. Okay. So the Hello Founder community is a community for African starting and aspiring budget entrepreneurs, but it's also open to other people. So if you're not African and you're starting a business, but you don't have a lot of capital, it's a wonderful community where I share resources, information, tools, yada, 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 that would help you to grow your business and also build the life that you dream of. So we share resources around personal development and business, all for budget entrepreneurs to help us build the business that we want to build. Okay, enough about all of that. Let's get into the topic of this video. The first thing that I would say is so important if you want to get your business to become profitable is to understand first and foremost the difference between profit and revenue. In very simple terms, revenue is how much you've sold from your business in total. Profit is how much belongs to you from your business outside of expenses and costs. Let's say it costs you $30 to create a product or service, and then you're selling it for $50. So at the end of the day, your profit is supposed to be $20. So that is like the primary level for you to look at revenue versus profit. Is that revenue is like the total amount of money that you're paid for something, and profit is how much of that money actually belongs to your business after you've removed. So now that you've gotten up to speed on the difference, the next thing that I want you to do if you want to be profitable is number 2, track your expenses. And let's just talk about expenses for a little bit. A lot of entrepreneurs, when they think about expenses in terms of COGS, that is cost of goods sold, and then they exclude operational expenses, operational costs. I did this so much in my business before that I didn't even know that there was a difference. So let me explain to you guys what the difference is. I have like a broken finger, as you guys can see, and I refuse to let it stop me from shooting this video. Anyways, so I'm just going to explain the difference. COGS, which is cost of goods sold, is exactly how much it costs you to create one particular product. So it refers to the direct cost to creating one particular product. So for example, if I'm thinking about the cost of, say, creating my animation course, which is one of the courses that I share in the community, I will be thinking about things like cost of the internet, cost of marketing the product, so things like that, because those are directly connected to the animation course. So I had to buy internet to run the course and create it. I had to pay for some fees to market the course to people. Anything that I have to spend to create the course specifically, that is the COG, the cost of goods sold for that particular service that you're offering. Operational expenses, on the other hand, is completely different. So operational expenses simply refers to the cost of running your business on a day-to-day basis. So if you have a business, for example, for me that I was running a startup, Hello Founder, the cost of running the community would be the cost of paying subscription on the platform I'm running the community on, the cost of marketing generally for the community, cost of fuel to run my car, to run the generator when I need to use it. Yes, if you're not in Africa, we use generators in Africa, so yeah, because we need electricity, stable electricity. So the cost of that, the cost of internet every single month. And so every single month you have operational expenses and you have COGS. So what you want to do if you really want to get profitable is to separate both of them. So have like COGS and have operational expenses. And anytime, if you really want to just know what your operational expense is super fast, think about the expenses that you spend, things that you spend money on, even if you're not making a sale. And then your cost of goods sold, think about the expenses that you only spend when you're creating a specific product. And once you've done this, I want you to write all of that down and just keep it somewhere so that it's really, really clear to you. And the next thing I want you to do is start tracking those two things. So you kind of need to always track how much you're spending. So that's both operational costs plus cost of goods sold. And after this, number 3 is to start tracking how much you're making. How much are you making every single month? That's also very important. So if in your business, say at the end of the day, you find that you're spending in operational expenses 50,000, or let's say that your expenses is 50,000, but you're making every single month 30,000. How are you going to become profitable? If your expenses are way more than the money that's coming into your business, you really can never ever be profitable. So you need to get really, really clear on how much you're making every single month and how much you're spending every single month. Another thing that this will reveal to you is the state of cash flow for your business. And like we always say in business, cash is king, cash flow is God. That's just how I look at it. And so if you have a business, you want to make sure that you are cash flow positive, you are not cash flow negative, okay? And so you just want to track that. If you don't have any tool to track it, you can use tools like Wave. So you can use the accounting tool called Wave. It has a free plan, I believe, or it's free. I've never really used it. I personally use Loiverse to track my expenses. So you can use Wave to track your expenses and see just exactly how much you're making versus how much you're spending. Okay. The next thing that you want to look at now is your profit margin, your net profit margin. So these are like different figures. I'll explain it as we go so that you don't get confused. So the first one is your profit margin. So in your business, okay, there's a difference between gross revenue and your gross profit margin. Your gross revenue, like I said, is like the total of your sales, how much you have made already in your business. That is your revenue. That's all the money that you're making in. Your gross profit margin is the percentage of. Okay guys, so I just had to change my background really quickly because I felt like there was a lot of things going on and I just want like a clean space for me to just talk more. Maybe this like be the background I'll maintain. Tell me in the comments if you prefer this background or you prefer the other one, the one with like the green background, the shelves and all of that. So talking about how to calculate your profit margin. So I want you guys to understand that the profit margin is like the indicator for how profitable your business can be, because if your profit margin is high and your expenses are like way higher than your income, then it's still going to be a business that will be struggling. But your profit margin will tell you if this business is healthy profit wise or can be healthy profit wise. So the simple way to calculate your profit margin is just this. Take the amount of money that you have made in revenue minus the amount of money that it costs you to create the product. So for example, if it cost me 200 naira to create a book and I'm selling it for 250 naira, all I would do is say 250 naira minus 200 naira. So 250 naira is my total revenue, 200 is my cost of goods sold. I'm going to minus that and I will have 50 naira, and then I will say 50 naira divided by 200 naira, and automatically your profit margin is 0.25%. Now what that means is that for every sale that you make, you're keeping 25% of that sale as your profit. Now if you really want this business to grow and scale, how long do you think is going to take to happen? Because at 0.25% profit margin, it's scaling will be very, very difficult, okay? And then having a lot of money in the bank real quickly will be very, very difficult. But imagine if my profit margin was say 70%. So imagine if it cost me 200 naira to create a notebook and I'm selling it for say 1,500 naira. Which of those business do you think is being profitable or has the chances of being massively profitable? And so for you to know if your business is profitable, I want you to right now calculate your profit margin. So the first thing that I need you to do is just think about one of the products that you're selling or your service. Now, businesses that are healthy financially are businesses whose profit margin for me exceeds 45 to 50%. In fact, if you exceed 50%, you're a healthy business. Below 50%, anywhere below 45-35%, I don't know how you're going to, I don't just know. A lot of businesses that were created and they have like lower prices, but what you don't understand is if you're going to follow the process of those businesses, you need to know that those businesses expanded using loans, a lot of them, and they compete on economies of scale, and the cost of production is super low. So for example, you could look at the Walmart model and be like, oh, Walmart sells this thing for $15, I'm going to sell it for $15. What is going to happen to you if your cost of production is $10 is you're going to be struggling. Meanwhile, Walmart will be moving up. Walmart has to expand with loans and investor money. You, on the other hand, may not have those resources available to you right now. Walmart can produce 1,000 pieces of one thing and have way more, like their cost of production will be super low, plus they're not doing it in their country. You, on the other hand, have to create it by yourself, and your cost of production will be higher, way higher. So the point is, you need to understand what your profit margin is. Now, I also want to point out the biggest mistake that people make when it comes to this profit thing is when a business owner just says, oh, my cost is $200, I'm going to make it $300, and that'll be how much I'll price my product. No, I always price my products and services based on profit margin. So if this thing is costing me this amount of money, I want to make sure that my profit margin is at 50% or higher. And for me, it's like, if I'm going to a business and I find that it doesn't have a healthy profit margin. So there you have it, guys, the second phase for figuring out how profitable. The final point for calculating this profit or figuring out if your business is profitable is calculating your net profit, number 3. So net profit is the most important indicator of profitability. Why? Remember when we talked about profit margin, your gross profit margin, we did not talk about operational expenses. We just talked about cost of goods sold. That's just one indicator of how profitable you can be, right? So it's the indicator. Now you need to calculate your net profit, and net profit is going to take into everything, including interest, if you're paying for that, operational expenses, taxes, all of that. And so if at the end of the day, your gross profit, like we calculated, is $50 and you're excited, your net profit is going to also cut into the $50. So when you're calculating net profit, then what you're looking at is saying $200 being your the revenue, minus $150 being the cost of goods sold, minus $10 being tax, minus this dollar meaning this. And by the time you've gone through all of that, you figure out that shit, I'm broke. Facts. So if you want to have a profitable business, you have to calculate all of these things in your own business to make sure that you're collecting your actual coins, And let me tell you guys, if you calculate from this point of view and make decisions from this point of view, it becomes really difficult to underprice yourself because you know exactly how much it's costing you to run your business.